Welcome to This Explainer. Okay, today we are taking what can honestly feel like an impenetrable fortress, the China Enterprise Income Tax Framework, and we're breaking it down. We are going to unpack all the complexities so you can navigate your corporate structure's tax liabilities without getting caught off guard.
We're going to be unpacking the three pillars of tax exposure today. So we'll start off with the tax residency trap, then look at permanent establishments, figure out how to calculate that PE tax, navigate withholding taxes, and finally, look at claiming those sweet treaty benefits. Let's get right into it.
All right, part one, the tax residency trap. This is the deepest level of exposure.
So, is your foreign company secretly a Chinese tax resident? It's kind of a scary thought, right? This is a hidden trap that could expose your offshore special purpose vehicle to Chinese taxes on its entire worldwide income. You might just assume that because your company is formally registered in, say, Singapore or Hong Kong, you're perfectly safe. But if your offshore operating company is primarily owned or controlled by China-based persons, the tax authorities might just look at your operations and ask that exact question. Is your foreign company secretly a Chinese tax resident?
Because the crucial point here, and you really need to remember this, is that it's not just about where your company is legally registered on paper. It's about where your company's heart and brain actually operate. The authorities use a test, and it's called the place of effective management. They're looking really closely at where the overall management and control of your manufacturing, your personnel, finance, and major assets actually take place. If the real decisions are being made by executives sitting in a boardroom in mainland China, well, your offshore company is stepping right into the trap.
So how do we fix this? To keep your non-Chinese tax resident status secure, you've got to build some actionable protective shields. You literally must actively set up your corporate governance to prove that management is genuinely offshore. Keep the company CHOP, your official corporate seal, along with accounting records and board minutes safely outside of China. Physically hold your strategic board meetings abroad. And critically, you need to ensure that less than 50% of your senior management habitually reside in China. Moving key business functions like finance or R&D overseas, that further solidifies your position.
Moving on to part two, permanent establishments, or PE explained. This is the middle tier.
This happens when you aren't a resident, but your specific activities inside China actually trigger a taxable presence anyway. If you trigger any of these four types of permanent establishments, your China-connected income is suddenly subject to a standard 25% tax rate. First, there's the fixed place PE, which requires physical and temporal permanency, like setting up a branch or a factory. Second is the construction site PE. That triggers if a project lasts more than 6 months. Third, we have the agency PE, where someone is habitually entering into contracts on your behalf in China. And finally, the service PE. This one trips if your employees provide services in China for an aggregate of more than 183 days within any 12-month period. And the anatomy of this trap really comes down to substance over form. Just tweaking who assumes the risk completely changes your tax exposure. Imagine a scenario where the parent company assigns an employee to a subsidiary, but that subsidiary directs the work and takes the risk. In that case, you trigger no PE. But if the parent company continues to direct the work, assumes the risk, and pays the salary, bam, a PE is triggered. Like I said, it is all about substance over form.
Okay, part three, calculating your PE tax, knowing your exposure.
If you do accidentally fall into one of these PE traps, well, how much is it actually going to cost your bottom line? Naturally, the tax bureaus want to see complete accounting records that accurately reflect your taxable income. But if your records aren't perfectly organized, they default to calculating your tax using deemed rates based on your actual revenue or expenses. Basically, they're estimating your profits for you, and trust me, that isn't always in your favor. To put this into perspective, the absolute baseline minimum deemed profit rate is 15%. If you're in engineering or consulting, it hovers between 15 and 30%. But for management services, they can deem your profit to be 30 to 50% or actually even higher depending entirely on the tax bureau's judgment. Meaning, if your documentation is sloppy, your tax bill could literally skyrocket purely based on an estimation.
Part 4. Navigating withholding taxes. This is the passive tier.
So this passive tier of exposure applies when, maybe you've successfully avoided a PE, but you're still receiving passive income flowing out of China. Visualizing your corporate structure is super key here. The exact moment those dividends leave your Chinese foreign investment enterprise and flow upwards to your overseas holding company, a withholding tax is applied right at the border. And this same rule applies whether we're talking about dividends, interest, royalties, or capital gains.
But here is where proper planning yields absolutely massive savings. The standard EIT law states a 20% withholding rate, but the implementation rules generously reduce this to 10%. Now, by leveraging a double tax agreement, or DTA, like the one China has with Singapore, for example, you can slash your dividend tax rate from 10% all the way down to just 5%. You just need to hold at least a 25% ownership stake. Interest drops down to 7%. That is a huge boost to your profitability.
Finally, Part 5, Claiming Treaty Benefits, Securing Your Reward. Now hold on, because you can't just claim these fantastic 5 or 7% treaty benefits automatically. You actually have to prove to the tax authorities that you genuinely deserve them. Under the new Bulletin 9 rules, your recipient company must be the true beneficial owner of the income and not just some empty shell. The authorities are fiercely cracking down on treaty shopping. If you set up a mailbox company purely to grab that 5% rate without having any real operations there, China is going to see right through it and deny your treaty benefit.
To actually win that treaty reward, your company literally needs a pulse. We're talking real employees, real independent decisions, and real business risks. These are the indicators of substantive business activities that the authorities desperately want to see. They want to look at your holding company and see dedicated personnel. They want to see material business functions happening independently from the rest of the group. If your board of directors is actively making decisions and assuming actual business risks in that foreign jurisdiction, well, then you are proving your economic substance.
On the flip side, you really want to avoid these unfavorable red flags. For instance, immediately funneling more than 50% of the dividends you receive to a resident of a third country within 12 months. That practically screams to the authorities that you're just a conduit. Other massive red flags under Bulletin 9 include having no substantive manufacturing, trading, or management activities, enjoying a super low effective tax rate, or relying on back-to-back loans. If you have these factors going on, the Tax Bureau will aggressively challenge your beneficial owner status.
So how do we practically claim this? Well, pre-approvals are pretty much a thing of the past. You now follow this self-assessment workflow. First, the non-resident conducts their own assessment on whether they are eligible. Second, you just submit an information reporting form when you declare. But here is the absolutely critical part. You must keep your tax resident certificates and substantiating documents pristine for future tax inspections. The withholding agent doesn't check your proof up front anymore. They just file the form.
And this right here is exactly why diligent compliance matters so much. Because there's no pre-approval, the burden is entirely on you. If you self-assess, claim that lower treaty rate, but later fail a tax inspection because your documentation was weak, you can be subjected to a devastating penalty of up to 3 times the tax underpaid. Nobody wants that.
So as we wrap up this explainer, I want you to take a really hard look at your China operations. Is your corporate structure a secure fortress, protecting you through true economic substance? Or is it an accidental tax trap just waiting to spring a residency or PE penalty on you? Take the time to review your governance, monitor your employee travel, and ensure you are the true beneficial owner. Thanks for joining me today. Stay curious and keep learning.